It's that time of the year again. I'm not talking about shopping for the kids. I'm talking about 2024 predictions, especially for our favorite dividend plays, big yielding closed-end funds, CEFs. It's a particularly good time to talk about CEFs because the 2022 sell-off has left us some pretty sweet deals that are still around, even though 2022 ended more than 11 months ago. Chief among these held over bargains is the 11.7% paying CEF we'll get to in a sec. First, when it comes to predictions, we should be clear that these days, the market mood tends to shift around the time the calendar flips. We saw this last January, and prior to that in early 2022, when inflation fears got real, and in 2021, when a pandemic recovery seemed likely. Prognosticators seem to be aware of this because this time around they've gone out of their way to say their confidence in their 2024 forecasts is low. Predictions of next year's economic growth from U.S. banks, for example, range widely. The Economist reported US GDP estimates of a bit over 1% growth, from UPS, for 2024, to more than 2%, Goldman Sachs. This is different from last year, when we were told the odds of a 2023 recession were 100%, a call that turned out to be 100% wrong, as we could tell simply by following the data here at CEF Insider. Recession calls missed the mark because earnings gained as the market climbed out of the 2022 panic. The 5% earnings growth in the third quarter of 2023, happening against an already strong 4% rise in 2022, shows real momentum that we see in other data points: slowing inflation, continued retail spending strength and consistently low unemployment, for example. All of this has driven stocks to the high, but somewhat range-bound, movement we've seen since early summer. Sell in May and go away is a cliché you hear a lot in the spring, and the summer market softness that underpins that saying can show up when there's no major news, as has been the case since the Silicon Valley Bank collapse and mini-crisis fizzled. But enough about the past. Let's look at what the next couple months could hold for us. We rarely use technical analysis at CEF Insider, but it's useful here because we see the formation of an inverse head and shoulders pattern, a textbook bullish setup. The breakout in November, then, was not surprising and is a sign of bear capitulation. In plain English, this means the idea that we're facing another crash, an idea that's had a lock on risk-averse investors for 2 full years, has finally become unfashionable. There's little reason for December to spoil the party unless we get bad economic news, and that's rare in December, since holiday spending masks any issues at least until January. One reason why market moods can quickly shift at the start of a new year.